Every time you buy a piece of stock, you're effectively buying a small fraction of ownership in a company. That is why they call it a share. Every share represents an apportioned part in the ownership of a company. For example, if a company has 1,000,000 shares of outstanding stocks, one share means 1,000,000th ownership of a company, and 300,000 shares is equal to 30% ownership of it. Since having a share makes you a quasi-partner/owner of the corporation, you receive some special rights and privileges. Among them is the right to vote on issues that could affect the future of the company. It's a small voice, but it's a voice nonetheless. Another important thing is that you will share in the profits of the business. So, when the company pays out the profits in the form of dividends, you get your equitable share as a stockholder. Companies issue stock as a means to raise capital for expansion, special projects, or operational needs. One of the main factors that drive the stock price up or down is the company's profitability or non-profitability. The shareholders, people or entities that own shares of stock in the company, naturally stand to make money as well when the company is bringing in lots of profits. Conversely, if the company is losing money, the shareholders stand to also lose money on their investments. If things really get so bad, the company may go bankrupt and eventually close down. The stockholders are usually the last to get their money back from the company, if any is still left later, and therefore at the losing end from their investments. This is the inherent risk when you invest in stocks. Investing in stocks? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial educative videos.